The $56 billion plumbing project. TSMC is committing $56 billion in capital expenditure this year because the front of the chip has officially run out of room. As of June 2026, the A16 node is no longer a research project. It is the industry's response to the thermal wall that is killing AI scaling. By moving the entire power delivery network to the back of the wafer, TSMC is essentially replumbing the transistor to prevent the voltage drops that have haunted the 3-nanometer generation. This move is designed to protect the 60% gross margins that investors expect by locking in the next generation of high-power hardware. The electrical engineering behind this shift is far more aggressive than the marketing slides suggest, and it signals a fundamental change in how silicon is built. The high-risk superpower rail. The technical differentiator for A16 is something TSMC calls superpower rail, and it is a significantly higher risk play than Intel's current 18A architecture. While Intel uses tiny through-silicon vias to bridge the gap, TSMC is making direct contact between the power rails and the transistor's source and drain. This removal of the middleman eliminates a massive amount of electrical resistance, promising a 20% reduction in power consumption at the same clock speeds. However, this complexity is why A16 is only hitting risk production now, while Intel's Panther Lake chips are already on retail shelves. TSMC is betting that their superior yield consistency will eventually outweigh Intel's 6-month head start, but the execution window is narrowing. The yield war for AI logic. For the first time in a decade, TSMC is the one playing catch-up on a fundamental architecture shift, even as they guide revenue growth above 30% for the year. The industry is watching the upcoming VLSI symposium next week, where the A16 specifications will be stacked against Intel's 18AP process. Rumors of Nvidia's Feynman chip being the lead customer for A16 indicate that the demand for 1,000-watt GPUs is driving this roadmap more than the mobile market ever did. But the real friction is in the OpEx. These backside power tools require proprietary wafer bonding and thinning equipment that adds a massive cost floor to every wafer. If the yields don't hit 70% early, the price per chip for AI customers will become unsustainable. The signal under the noise. TSMC's A16 strategy reveals that the Angstrom label is a secondary marketing distraction from the real shift toward power density management. While the previous sections focused on the superpower rail and the Intel rivalry, the underlying reality is that the foundry business has transitioned from a race for smaller gates to a race for better electrical plumbing. This means the profit pool is shifting toward companies that can manage the extreme heat and power delivery of AI racks at a massive scale. For operators and investors, the key metric is no longer the 1.6-nanometer nameplate. It is the yield of that backside contact layer. Watch the Q4 production ramp as the definitive indicator of whether TSMC can maintain its pricing power, or if the high capital intensity of A16 will finally begin to erode those industry-leading margins. The winner won't be the company with the smallest transistor, but the one that delivers the most stable voltage to the rack. Subscribe for more